What are three things everyone should know about recessions? Welcome to the latest LPL Street View. If the economy does indeed enter a recession, the causes and potential outcome will be hotly debated. So at LPL Research, our starting point is always looking at history. So let's talk about those three things about recessions. First, a recession does have an important technical definition that's different than what many people think. So earlier this year, when growth was negative, many were under the false impression that two consecutive quarters of negative gross domestic product, or GDP, imply a recession. Often that view is a good general approximation, but not the technical definition. The official definition of a recession is a significant decline in economic activity that is spread across the economy and lasts more than a few months. Now, for most investors, this definition does not sound very helpful and raises more questions than it answers about things like the meaning of significant. Well, the three factors for defining a recession are depth, diffusion, and duration, conveniently referred to as the three Ds. Depth refers to declining economic activity that is more than a relatively small change. Diffusion, well, that describes an economy that has experienced a contraction in a wide range of sectors, such as trade and business activity and consumer spending. Duration, well, that's likely the least important of the three Ds, and that measures the time between the previous business cycle peak and the following trough. Given the unique cause of the 2020 recession, the time between peak and trough was the shortest on record, only 2 months. The second thing to know about recessions is that we do have warning signals that usually precede a recession. And here they are. Consumer metrics, specifically real spending and personal income. Well, that gives investors an early read on the health of the consumer and are good warning signs. Employment activity, as reported by both businesses and households, well, they begin to decline before the onset of a recession. Industrial production, well, that often stalls during the beginning of a recession, indicating cracks in the business sector. Now, indexes such as the Conference Board's leading economic index, that gives early broad-based warnings about market conditions, and they are historically good leading indicators. So one reason we see healthy debate on the likelihood of recession that for most of this year, well, not all metrics were flashing warning signs. However, recent data may give us more clarity. The Conference Board's leading index as of September has declined 7 out of the last 9 months, showing that the economy could enter a period of broad-based contraction. The decline is predictable as many sectors, such as housing, started slowing months ago. And since the inception of that index, a decline of this magnitude over a 6-month period has always foreshadowed a recession in subsequent quarters. As such, we think recession risks appear more probable by the beginning of next year. If the economy does fall into recession, the cause will likely be from the consumer sector retrenching after years of inflationary pressures, high housing costs, and slow real wage growth. So third, and probably the most important thing to know, is recessions historically have not perfectly coincided with market declines. So bear markets, defined by a market decline of at least 20%, and recessions, they overlap, but investors should remind themselves that markets are forward-looking. So current market volatility is often about future recession risk. As predictable as this slowdown is, the markets have likely priced in much of the slowdown, but that remains to be seen. Taking a broader look at the markets than just officially designated recessions, we know historically that after a negative shock, the following 12-month equity returns are positive. History may not repeat itself, but it often rhymes. So during these contentious times, investors should remind themselves of the three Important things to know about recessions.